In the dynamic world of business, financial management is key. It drives growth, profitability, and sustainability. Effective resource allocation maximizes value creation, analyze data, forecast performance, make informed choices. Embrace these principles to enhance financial health and unlock growth. Stock valuation and the cost of capital hold paramount importance. These concepts provide a roadmap for businesses. Understanding stock valuation is essential for investors and companies. It guides investors towards potentially undervalued investments. By assessing financial health and industry dynamics, investors make informed decisions. Calculating the cost of capital helps businesses assess project feasibility. Common stock represents the most prevalent form of equity ownership in a corporation. Purchasing shares makes individuals part owners of the company. This ownership confers voting rights on significant corporate matters. Holders benefit from the company's profitability. A well-performing company increases stock value, rewarding shareholders. In corporate finance, maximizing stock price is a paramount objective. A high stock price reflects financial health and growth prospects. Strong stock prices attract investors and enhance brand reputation, but it shouldn't compromise long-term sustainability or ethics. Unveiling intrinsic value. The heart of stock analysis. Intrinsic value represents the true worth of a stock. It's based on a company's financial performance and future prospects. Determining intrinsic value requires deep analysis of financial statements and industry trends. Various models, like the discounted dividend model, help estimate intrinsic value. When market price is lower than intrinsic value, it's an attractive investment opportunity, bridging the gap. Aligning stock price with intrinsic value. In an efficient market, stock price should reflect intrinsic value. However, discrepancies exist due to market sentiment and investor behavior. These deviations create opportunities for astute investors. Understanding this helps in making informed investment decisions. Navigating the valuation landscape. A trio of approaches. Valuing a company's stock is like solving a complex puzzle. Analysts use diverse valuation models, each with strengths and limitations. The discounted dividend model focuses on future dividend payments. The corporate valuation model looks at future free cash flows. Market multiples models compare a company's metrics to its peers. The discounted dividend model. A cornerstone of stock valuation for companies that consistently pay dividends. It links stock value to the income stream it generates. By discounting future dividends to present value, investors estimate intrinsic stock value. Despite limitations, it remains a valuable equity valuation tool. Section 3. Beyond dividends. The corporate valuation model. The corporate valuation model, or free cash flow method, offers a broader perspective. It shifts the focus from dividends to free cash flows, representing cash after operating expenses and capital expenditures. Discounting future free cash flows to present value, using the company's cost of capital, estimates the company's intrinsic value. It applies to companies without regular dividends. Unpacking the model. Mechanics and assumptions. The discounted dividend model, or DDM, values stocks based on future dividends. The intrinsic value of a stock equals the present value of all future dividends. The DDM uses a discount rate, reflecting investment risk. This rate is the minimum return investors expect. Assumptions include indefinite dividend payments, and constant growth. These assumptions simplify valuation, but introduce limitations. Section 2. Navigating limitations. When the model falls short. The dividend discount model, or DDM, is valuable, but has limitations. It's sensitive to dividend forecast accuracy. Predicting future dividends is uncertain. Constant growth rate assumptions may not hold. Different investors have varying risk perceptions. Despite this, DDM is a valuable tool for stock valuation. Embracing free cash flow. The power of corporate valuation. The corporate valuation model, or FCF method, offers a robust approach to valuing businesses, especially those with unpredictable dividend patterns. This model focuses on free cash flow, a key measure of financial health and value generation for stakeholders. Unlike the discounted dividend model, the corporate valuation model takes a broader perspective. It recognizes a company's value from its ability to generate cash flow for reinvestment, debt repayment, or investor distribution. This is ideal for valuing growth phase companies reinvesting heavily and lacking consistent dividends. The intrinsic value equals the present value of all future free cash flows. Discounting these cash flows using the company's cost of capital estimates its intrinsic worth. This approach provides a comprehensive assessment of a company's value, considering its cash generation and future growth potential. Section 2. Navigating complexities, applications, and considerations. The corporate valuation model is a powerful tool for valuing businesses, but it requires careful consideration of its complexities. Accurately forecasting future free cash flows is a primary challenge. This requires understanding a company's business model, industry dynamics, and competitive landscape. Analysts must make assumptions about future revenue growth, profitability margins, and capital expenditure requirements. Another key consideration is selecting an appropriate discount rate, often referred to as the weighted average cost of capital, or WACC. Determining the WACC involves assessing the cost of each source of capital. The model's accuracy also depends on the terminal value estimate, representing the present value of all free cash flows beyond the forecast period. Assumptions can significantly impact valuation, highlighting the importance of sensitivity analysis. Despite its complexities, the corporate valuation model is valuable for understanding a company's intrinsic value. Its focus on free cash flow makes it a robust approach for valuing businesses. Bridging debt and equity. The unique nature of preferred stock. Preferred stock blurs the lines between debt and equity, making it a hybrid security. It offers fixed dividend payments, appealing to investors seeking steady income. Unlike common stockholders, preferred stockholders usually have limited or no voting rights. They have priority in dividend payments and asset distribution in liquidation. This provides a layer of protection, though dividends are not guaranteed. Companies can omit preferred dividends without legal repercussions. Fueling growth. Exploring the sources of capital. Companies need a constant flow of capital to fuel operations and pursue growth opportunities. They tap into various sources of capital, each with unique characteristics and costs. These sources can be categorized into debt, preferred stock, and common equity. Debt financing involves borrowing money with a promise to repay with interest. Debt offers tax deductibility of interest payments, reducing borrowing costs. It also allows companies to leverage their equity base, amplifying returns. Preferred stock combines features of both debt and equity. It provides a fixed income stream and a claim on assets ahead of common stock. Common equity represents ownership and is raised through issuing common stock. Shareholders have voting rights, receive dividends, and benefit from capital appreciation. The optimal mix of these sources depends on the company's industry, growth prospects, and risk profile. The WACC equation, unlocking the cost of capital. The weighted average cost of capital, or WACC, represents the average rate a company expects to pay to finance its assets. It reflects the cost of raising funds from debt, preferred stock, and common equity. Each source has its own cost, influenced by interest rates, market risk premiums, and the company's risk profile. The WACC equation blends these costs, weighting them by their proportion in the capital structure. It serves as a benchmark for evaluating investment opportunities. Companies aim for projects with returns exceeding their WACC to create value for investors. Section 2, putting it all together, calculating and applying. WACC. Calculating a company's WACC involves several steps, each requiring careful consideration of market data and financial projections. The first step entails determining the cost of each capital source. For debt financing, cost is typically represented by the yield to maturity on the company's outstanding debt. Preferred stock's cost is calculated by dividing the annual preferred dividend payment by the current market price. Determining the cost of common equity often poses the greatest challenge. Common methods include the capital asset pricing model, or CAPM, and the discounted cash flow model. Once the cost of each capital source is determined, they are weighted according to their proportions in the company's capital structure. These weighted costs are summed to arrive at the WACC. This WACC represents the hurdle rate that a company's projects must clear to be considered value creating. It's important to note that the WACC can fluctuate over time due to changes in market interest rates or the company's risk profile. Therefore, it's crucial to reassess the WACC periodically to ensure its relevance in guiding investment decisions. By mastering the WACC, companies can make informed decisions about capital allocation and maximize shareholder value. Unveiling the cost of equity. A balancing act. In corporate finance, determining the cost of common equity is critical yet challenging. Unlike debt costs, which rely on market interest rates, the cost of equity delves into investor expectations and risk perceptions. It represents the return investors require for holding a company's stock. This cost of equity is crucial for calculating a company's weighted average cost of capital, or WACC. A company's cost of equity is linked to its perceived risk. Companies in volatile industries typically carry a higher cost of equity. Accurately estimating the cost of equity is essential for sound financial decisions. Navigating the methods CAPM, DCF, and beyond. No single method for calculating the cost of equity reigns supreme. Analysts rely on a toolkit of approaches, each with its own strengths and limitations. Among the most widely used methods are the Capital Asset Pricing Model, or CAPM, the Discounted Cash Flow, or DCF model, and the Bond Yield plus Risk Premium approach. The CAPM estimates the cost of equity based on the company's beta coefficient. Beta measures the volatility of a stock's returns relative to the market. The DCF model calculates the present value of expected future cash flows. The bond yield plus risk premium approach starts with the company's cost of debt. A risk premium is added to the bond yield to estimate the cost of equity. A prudent approach involves using multiple methods to arrive at a well-rounded estimate. Mastering the fundamentals. A foundation for success. In finance, mastering stock valuation and the cost of capital is like acquiring a financial compass. These concepts guide investment decisions, maximizing value creation. We have explored the significance of common stock and intrinsic value. Our journey covered valuation models and the discounted dividend model. We also touched on the relative valuation approach using market multiples, empowering decisions, unlocking value. Understanding the cost of capital sets the benchmark for evaluating investment opportunities. The weighted average cost of capital, or WWACC, reflects the cost of raising funds from various sources. With a solid grasp of stock valuation and the cost of capital, businesses and investors make informed decisions. Companies can evaluate projects to ensure returns exceed their cost of capital, creating value for shareholders. Investors can identify undervalued stocks and manage portfolios effectively. Embrace these concepts to navigate finance, unlock value, and achieve financial success.